Investors, welcome back to the channel. My name is Ari Gutman. And as you know, every single week I am delivering through on brand new stock ideas as well as economic insights. And every now and then I have the honor and privilege of having another master of the market, a guest speaker on with me. And today I have none other than Chuck Carnevale here with me. He has investment experience since the 1970s, opened up his own investment firm, and of course, he is the founder of Fast Graphs. So please help me welcome to the show here, Chuck. Chuck, thank you so much for joining us. And I want to right away put you on the hot seat a bit
All
here
right.
and go to the Chuck Carnevale story. I want to know your background, how you grew up, how you got to where you are. If you can give us this brief, because I'm going to be honest with all of those viewers out there, the introduction that I know to deliver through on for Chuck is vast and it's depthful and there's a lot to unpack, but there's no better man than himself, Chuck, to unpack it with us. So Chuck, what is the story you got behind you?
Well, I don't know how far you want to go back, but I've always had kind of an entrepreneurial spirit, I guess you would say. And
Sure.
um, I'm a service vet. I served in Vietnam, and when I came out of Vietnam, I enrolled in the University of Tampa, where I met an economics professor by the name of Elvin F. Terry
Mm,
that really had a major impact on my investing career and my ideas about how investing was. I was very interested in investing. I was studying finance and economics in college. And one of the things that this professor did in one of our classes it was actually on macroeconomics, actually, but he was looking at the stock market. And he had a study that Pershing had conducted. And what they did was they correlated the S&P 500 stock prices with S&P 500 earnings going back about 50 years at that time. And this was in I'm going to say 71 or 2.
sure.
And the professor used to pound the table with his fist, literally. I mean, he would literally take his fist and hit the table. And when he was talking about stocks and how you value stocks and how you evaluate stocks, and he would say earnings determine market price.
Mm,
And he would just pound this into our head. And then he showed this graphic that Pershing had conducted, where it was like 50 years of, the price of the stock of the S&P 500 correlated to its earnings.
sure.
And it was really a profound correlation. It really showed that ultimately, where the company's operating results go is where the company's stock price is going to go. But in the short run, there's a lot of volatility. And so when I eventually did start a money management firm, I named it sort of in his honor as EDMP, which is earnings determined market price, but that was in the long run.
Sure.
But I think it's very important to point out when you're looking at stock prices and volatility that there's an evil twin sister EDMP in the short run, and that's emotions determine market price in the short run. So the whole idea about value investing is to try to participate in the growth of any business that you're looking at investing in. Or
Sure.
I don't want to just say growth. You want to participate in the growth and income of that business that you're considering investing in. And if you're a good shopper, no matter what you shop for, you want to basically get a bargain. And so the whole idea is to try to find a valuation that allows you to fully participate in what the company can deliver. If you overpay, you'll do less. If you underpay, you can actually do more. But the secret is to try to determine based on the cash flows, operating earnings, and cash flow is really even more pertinent probably than earnings that a
Sure.
business is capable of generating over time. So that's how I got started.
Now, you mentioned a lot there, and you mentioned fear, which is one thing that stood out to me. Because to be honest with you, as I go back, into my investment career, I started off investing in my early 20s. Now, I had a lot of
That's
fear.
great.
I also had a lot of fear because of uncertainty, right? I didn't have the knowledge. And I feel like a lot of investors out there jumpstart into the market and are trying to get rich very quick, but fear does play a big role. And you mentioned you were a serviceman, you served in Vietnam. Thank you so much for your service.
Thank
Of
you.
course, it's even more of an honor to have you on, knowing you're a serviceman. Now you're very humble, and you also won an honor medal, if I'm not mistaken, in the Vietnam War. So it sounds like a very right, a
Yeah.
fearsome warrior. And I want to ask, when it comes to fear, especially in the stock market. Do you think that the military, being a serviceman, played a role in your ability to navigate through fear and uncertainty?
I mean, obviously, going through a war and serving in the military was something that, like they say, builds men. I mean, obviously, it was an experience that, you know, made me grow up very quickly as a young man, and it did, give you the opportunity to kind of test your mettle, so to speak, to see whether or not how you would react under certain situations. Of course, in a war zone, there are those. So yeah, I would say that probably had some, but one of the things that I've always talked about, getting back to kind of the investing world, is that knowledge is power. This was one of the things, again, my original mentor, taught me. The one, my economics, his name was Alvin F. Terry, and he used to pound the table, say earnings determine market price. What the lesson he was teaching me was that the business is what ultimately generates your rates of return when you invest, not the fluctuations in stock prices. And so when you mention things like, controlling fear, I've always said knowledge is power.
I love it.
And so the more you can know, the more power you can actually bring to the investing equation. And when you look at things that are relevant to the investing world, you got things like stock prices. They're very unpredictable. And you never know where the price is going to go in the next minute, next month, next week, next day. And I do believe that trying to forecast short-term price action is an exercise in futility. But if you're looking for predictability and something that can help ease some of the fear, then I think you're much better served looking at things like operating earnings, operating cash flows, sales and revenues, EBITDA, and metrics that are first of all, they don't report quarterly. A friend of mine used to joke and say the companies report quarterly or 4 times a year, whichever comes first. And there is a little bit of humor to that. But the point is, some companies, produce fiscal years, some companies produce calendar years. Sure. But the point is, you really only get knowledge or information about a company every 4 months, so to speak. You don't, in the middle, it's all noise. Sure. And investor psychologists, have, done numerous studies, and what they've taught and what they prophesize is that investors fear the pain of loss 2.5 times greater than they enjoy the pleasure of gain. And I think that's where fear and greed are the two primarily major emotions that deal with investors are struggling with and grappling with. And fear is definitely the more powerful, because people are 2.5 times more likely to react to fear than they are to, making money or gain. So greed can drive stock prices in the short run, but fear can, really be the dominant factor. So the whole idea here is to try to eliminate the emotions of fear and greed. And you do that by focusing on the things that are more predictable and more reliable. And I'm sure we're going to eventually get to this, but earnings and cash flows are better than stock prices. But ultimately, probably the most reliable and predictable aspect of investing. And by the way, the only thing, certain about the future is uncertainty, as you kind of mentioned. Yep. But when you're looking at things like earnings and cash flows, that's more predictable than stock price. But ultimately, dividends are the real most predictable aspect you can look at. And, dividends tend to be very consistent, especially if you're dealing in what I call the, premier dividend stocks, the companies on the aristocrats list. Sure. Or a friend of mine, actually, who passed, David Fish, used to produce, did produce or create a list called the CCC list. And they were dividend champions, contenders, and challengers. And these were companies that had, either 5 to 10 years of increasing dividends or 10 to 25 years in a row. And then ultimately the champions were like the aristocrats, 25 years or more. And once companies get on one of those prestigious lists, it becomes kind of important that they stay on that. So that gives you a little more predictability that the dividend is probably something that the management team is going to prioritize.
Sure. Now, do you yourself, as an investor on a personal level, do you tend to look more into dividend stocks than you do growth stocks? Or what, like when Chuck is out there looking for new stock ideas, are you looking primarily for dividends as a sense of stability?
Well, there's obviously the old jokes about eating green, buying green bananas and things when you get, my age, for example. And I do think age is important in making investment decisions. And it's not age as much as it is how much time you have, because there is going to be volatility in stocks. That's unavoidable. You can't avoid that. And there are going to be times where you're going to have recessions and you're going to have, bear markets and bull markets. Now, one thing that people tend to, I think, often forget about, fear and greed comes into play again. Bear markets tend to be relatively short-lived, at least historically. Bull markets tend to last an awful lot longer. But people fear the bear market so much that, they become the focus of, the point. And we've been in the United States, or we've been in a long-running bull market, one of the longest in recorded history. But I'm going to interject this now. I think it's a good time to do it. It's also a market of stocks, not a stock market. And I tend to think in terms of individual stocks rather than I do markets of stocks, because some stocks grow fast, some stocks grow slow, some stocks pay a dividend, some stocks don't. But to answer your question more specifically, I do believe that as you go through life, and depending on how many years you have, let's say, to facing retirement, once you get to retirement, I do think dividend stocks make the most sense, because at that point you want to have your money working as hard for you as you work to accumulate that money over the years. Sure. When you're younger, I still believe there should be a balance to your portfolio. And when I used to do it, I used to run it based on ratios like 70-30, 80-20, 90-10, where depending on not just the age and how much time a person has, but their risk tolerances, their attitudes about risk, you try to, develop an investment policy statement that is going to work for the investor. And if an investor is real skittish and they can't handle risk at all, then you have to take that into account, because when you do run into the inevitable bear market, they're liable to do the wrong thing. There's a great teacher, I guess, of the financial planning industry. A gentleman by the name is Bob Veras, and I may be pronouncing that wrong, but he once said a quote that had a major impact on me. He said, "The definition of an excellent investment advisor is one that has the courage and integrity to insist that his clients do what they ought to do rather than what they want to do." And the reason that's so important is when the markets are bad, stocks are dropping, people's reaction to, fight or flight response kicks in, and they typically want to flee. They want to leave where they should be fighting. The best time to buy stocks is when they're low. Sure. The worst time to buy stocks is when they're high. But, people, emotional beings that we are, and, fearing fear more than we do, reacting to greed, we tend to want to leave when we should be buying. And, Buffett, I think, said it really eloquently when he said, be fearful when others are greedy and greedy when others are fearful. That's really good strategy if you're looking with, dealing with companies that have good fundamentals. And so ultimately, back to knowledge is power. It really comes down to knowing the businesses you're investing in and developing as much knowledge about those, and then adapting to the stock price movements as they occur. If the market's overvaluing your stock, that's, they call that the greater fool theory, where fools are, buying the stock on the basis that a fool greater than them is going to come along and even pay more, but they're foolishly overpaying for the stock. Where, on the other hand, buying a stock when it's on sale is very, very difficult, because, value investing implies almost by definition that you're buying stocks that are out of favor. Sometimes that they're out of favor for a reason. Sometimes it's just simply emotion driving it, and trying to make that distinction is really the job of the analyst or the job of the investor. Are you investing in a great company at a great price, or are you investing in, what they call value traps or things? And by the way, that can never be done with perfect precision, but that's why diversification comes into play. You've got to own, I'd like to own a minimum of 25 stocks, but I don't like to own a lot more than that, because I want to be able to know as much as I can about the companies I invest in.
It's great that you mentioned that, because we talk often as, dividend investors, as investors as a whole, on a portfolio size, how many holdings are within a portfolio. And it seems to be, honestly, through speaking with a lot of various dividend investors on YouTube, a very contested matter, right? Some believe less, some believe 70, 100. But I think what you mentioned there is key. 25, or at least however many stocks that you can contain that knowledge, because knowledge is the power. Right. But I want to go back quickly, because you have, of course, years, I mean, decades worth of investment experience, 1970s to
And the
present, where
scars
we
to prove it, by the way.
we got to
The
get you
portfolio scars, you might say.
we got to get you an honor medal just for investing. But you have all this experience packed in with this decades worth of investing. And of course, from the 1970s to present, there's been plenty of fluctuations within the market, ups and downs and market cycles. And, when I look at right now, at least from, where I stand and how I see it, we have the Federal Reserve increasing interest rates pretty hawkishly. Inflation has been steadily coming down. The labor market remains robust. But across the spectrum, we have investors and economists, some of which predicting that we could see this economic downturn, perhaps 5 to 15% come the year's end. And on the other end, we have investors out there saying, shrug it off and we're already in our bull market. Just keep doing what you're doing. But I'd love to know, right, through all this experience that you have, and especially through your strategy, if you can walk us through your strategy a bit and then talk about how you're planning, right, the remainder here of 2023 to look at investing and strategize for this type of environment.
Well, there are a lot of cliches out there in Wall Street. One of them is it's a stock pickers market, or it's a growth stock investors market or value. To me, it's always about picking the individual stocks that make the most economic sense at the time, regardless whether you're in a bull market or a bear market. Now, reality would simply, and common sense would indicate, in a bull market, it's going to be a lot harder to find good values, because obviously that's when greed is really running rampant and everybody's driving stock prices up. Back in the early 70s, we were just coming out of what they used to call the Nifty 50 stocks. And these were stocks like Halloyd that ended up becoming Xerox, and all of the premium blue chip stocks that were trading at 40 multiples and even 50 multiples. And they did this for years, and people said they were worth that. And then ultimately, once the interest rates started peaking, coming around the 80s, and those stocks really had their comeuppance and they dropped precipitously because the value wasn't there. The companies were great, but the valuations weren't great. So to me, the strategy is, I know when I'm in a bull market, it's going to be harder. And so I screen, for example, if I'm screening the S&P 500 today, and our fast graph tool, the tool that I developed, we have developed preset screens where I can screen the entire S&P 500. I don't have it off the top of my head, but we got about 70 stocks out of 500 that seem to make any economic sense in the S&P. So my world is I live in those 70 stocks. Now, not all of them are going to be great investments, by the way, but that's at least where some of the value exists. And now you've got to determine whether, I think the great investor Marty Whitman once said, he was the Third Avenue Value Fund founder, creator, and manager. Good group of mutual funds, by the way. And Marty said, we got to distinguish between a temporary interruption in a great business or a permanent impairment of capital. And I think that's really what the investor's job is to, there are going to be times where companies go through hard times. And there's no way of getting around that. I've never seen a perfect company yet. I've seen some that have really good track records. And I do covet consistency of, earnings growth, for example. But yet, on the other hand, I'll invest in a Caterpillar or a Cummins that are or an Eastman Chemical that are semi-cyclical, that have great long-term dividend records, because I know I'm going to face some cyclicality in there. And every company can run into an issue where there's a change in their market or whatever. And it's our job to try to determine that. And there's no substitute for comprehensive research and due diligence, number one. But even more importantly, there's no substitute for constant diligence. You have to be staying up with the investments you own. That's why I want to own no more than 25 stocks in a portfolio. Peter Lynch once coined a phrase in his best-selling book, One Up on Wall Street. He called it diversification.
Yep.
And you talked about this argument with people, and it really depends on your attitude towards risk. Now, I will do 30 to 35 stocks for clients that are more risk averse, but academic studies have indicated that once you get past 17 stocks, you use up most of the benefit that diversification will give you. 25 stocks means you can have 4%, in every stock, 5%, 20 stocks would be 5%, 25 would be 4% in each stock. That means if that one stock went bankrupt, and by the way, if you've done any kind of homework at all, the odds of a stock that you own going to zero is pretty remote. But you could have a stock that drop 25 or 30% in value if something happened to their fundamentals, for example.
Sure.
And we saw that recently with 3M as an example of blue chip forever that had some issues with some, it's some controversial subjects I don't want to get into, but the point is, there is always that potential of facing that. So if you have a small enough universe of stocks and you know them really well and you keep up with them and you continuously study them, and again, to me, that looks at every quarterly report, look at the company's guidance, and try to determine whether or not the company still possesses the characteristics that you invested into it originally. And I think you also have to be realistic. For example, very fast growing stocks tend to slow down the bigger they get. You run into the law of large numbers. And you got to be practical about that. And you can learn a great deal from the past, as I like to say, but you can only invest in the future. So my strategy is to try to identify great companies that are on sale and where the reasons are not permanent in duration, where there might be a temporary interruption. And I'll be able to accept that if I see a light at the end of the rainbow, if I see the ability for the company to come through that. And I think an important aspect of investing is to try to invest in companies that have had great track records and great management teams, because when the what hits the fan, those companies are the ones that are going to be the survivors coming out the other end.
Sure, sure. I always like to say, really, it's like the Buffett-proof pieces of criteria are companies with great leadership teams, right? Strong management, a great reputation, very reputable, and then, of course, a clean balance sheet. And those three pieces of criteria for me have done wonders for me as an investor. And of course, they've led me to dividend investing with a lot of these companies who meet that criteria. As a dividend investor, so many questions there are a lot of investors out there, right, who would say, fair disclosure, I'm 28 years old. I've been dividend investing, I want to say 4 or so years, been growing this dividend snowball. It's coming together very nicely. But what I hear often from a lot of investors, right, who have time in the market, and I do have some growth stocks within my portfolio, call it your Apples, Google, right, all bought at fair or undervalued, prices. Google, perhaps not as undervalued as or fair as I would have liked, but bought on the dips. And what I'll share, though, is what I've gotten in return is a lot of harsh sentiment for being a dividend investor. Why not go growth, Ari? And so I want to throw that one over to you, because I feel like on the flip side of the coin, there are so many young dividend investors out there who are really excited about dividend investing, really excited about value investing, and perhaps it's growth investing could scare them away, or whatever it may be for them. But what's the argument here, or what could be the case for a young investor like myself or those others who are out there who want to dividend invest? Is it the way to go? We'll get your answer.
Well, it's a way to go. And first of all, don't feed the trolls. Don't worry about the sentiment of other people. You follow your own heart. I think Shakespeare said, "Go to your bosom and knock there, and ask what it doth know." And you want to follow your own conscience and your own heart. I think it's critically important to know thyself as an investor, number one. Number two is nothing is as cut and dry as a lot of investors want to make it. The idea that you invest in dividend stocks doesn't mean that you're devoid of growth, for example. And growth is a very variant concept. There are companies that grow at 3 or 4%. There are companies that grow at 5 to 8%. There are companies that grow at 10 to 12%, and companies that grow at 20% or faster. But there's also some common sense practicalities about that. Number one is the faster a company's growing, a real high growth company, it's first of all very hard to achieve that growth and to continue. I used to like to tell the story of Ray Kroc when he bought the McDonald's company from McDonald's brothers. They had 4 restaurants. Well, it was easy to grow 100% and build 4 more restaurants. When you got 60,000 or 40,000 or 80,000, whatever McDonald's there are, it's real hard to go from 80,000 to 160,000, for example. So growth becomes more challenging the bigger a company gets. Again, pardon me, the law of large numbers comes into play. So there are, aspects of growth and then value. There's 3 ways you make money on owning stocks, technically. One is through the growth of the company's business. Earnings determine market price. and that's capital appreciation. And to get that, you have to align yourself with the intrinsic value of the business.
Sure.
The second way is, of course, going to be the dividend income. But then that has the elements of growth. How fast, if the company's dividend growth is going to be functionally related to how fast the company's growing. And
Sure.
some companies have low payout ratios, modest yields, but very fast growing dividends. Other companies have lower growth rates, higher dividend payout ratios, and slower growth rates. There are high yielding dividend paying stocks, moderately yielding, low yielding, and everything in between all of that, by the way. So the reality of it is not to be thinking in black and white, but all the various shades of gray that exist out there. And, the other point is that this idea that you can't get growth from dividend growth investing. I mean, look at companies that, like even Starbucks or
Sure.
young companies like Microsoft and Apple that were very fast growth stocks for all their, most of their history, that all of a sudden as they become larger, it was more impossible for them, because a young, fast-growing company will reinvest in itself, and they will use every bit of cash flow they can generate to grow their business. And Amazon is probably one of the greatest stories about that. But as a company gets bigger, finding great investment opportunities where they can get the appropriate, returns on invested capital and so on that make it worthwhile for them to reinvest their capital become harder to find. And then it makes more sense for them to start sharing their earnings and revenues and cash flows with their shareholders. And that's where dividend growth stocks come in. And, so it's a very complex story, but the point is you can make a great deal of money owning a low growth stock bought at attractive value than a very fast growing stock that's way overvalued. Okay. And so you've got to mix all these things in between. And as far as, your age, the idea that you can own dividend growth stocks, get good income and good growth of income, and even reinvest your dividends, by the way, over time if you're young, doesn't mean that you have to give up growth to do that. You could actually mix them all, but it's also a matter of adjusting risk, because obviously, the faster a company's growing, the more risky it is. It just, it's not, there's exceptions to every rule, but that's a general safe statement. A company that's growing real fast, it's challenging to grow fast. And also you're inviting competition. And that's really what happens. I mean, look at Home Depot, along came Lowe's,
Sure.
Look at Walmart, along came Target, and of course, it's just the same old story. Look at Starbucks now. There's a gazillion, young sprouting coffee shops out there coming up now, making it harder for companies like that. The market isn't going to let you have the market. You're going to invite competition. So it's all a matter of paying attention to valuation, having a realistic opinion of how fast a company can grow, and then measuring your opportunity. Now, one thing that I think investors fail to do, and that's why I think my fast graph tool, to put in a little commercial here, is so powerful. You can instantly calculate what if scenarios. What if the company's growth is at this level as analysts expect? What would my rate of return be if it traded at this multiple or that multiple or X multiple? I do believe investors, the idea is don't just throw a bunch of mud on the wall and hope some of it sticks.
Sure.
You ought to have a very clear idea of what the investment is capable of generating for you in terms of income, in terms of growth, and in terms of capital appreciation. And by the way, the third element, besides income and appreciation, can come from valuation anomalies, PE ratio expansion.
Sure.
And by the way, the opposite of that is PE ratio compression. If you're overpaying for a stock, you can get larger earnings in the future at a much lower multiple and end up not making any money. You can get a slow growth stock, buy it at a very low multiple, and get a PE ratio expansion, like that will give you what I call natural leverage, where the stock can go up. So the point is, know what you're investing in, know what it's capable of giving you, and recognize what the evaluation anomalies are, and then build a portfolio that you can live with. And that's going back to know yourself. You want to build a portfolio. If you're real nervous type and you're afraid, stick with really high rated, A-rated or better stocks, triple B rated at least or better companies with, as you mentioned, low levels of debt, et cetera. But keep in mind, even debt is not always necessarily a bad thing, especially when you had interest rate cycles like we went through in the last 10 years, where rates got so cheap, companies could borrow money at 1 or 2% and earn 8 or 10% on that money. And, they would do that all day long.
Sure.
And they were able to generate the cash flow. So it's all a matter of doing the research, knowing yourself, investing in things that, give you the opportunity to meet your goals and objectives and risk tolerances as you go down through this journey called investing. And always remembering that, the only thing certain about the future is uncertainty. There is no, no investor that's ever lived, including Warren Buffett. In fact, people don't, I think, realize that, his Berkshire Hathaway is named after his greatest failure. Okay.
Yep.
And where he lost a fortune on that. And, even the great Peter Lynch, Peter defied, his own rules about diversification. He invested in thousands of companies, but the reality of it is that no one has a perfect batting average in this business. It just doesn't exist. And there's going to be something it's the unknown and the unknowable that gets you in trouble. That's why you diversify. But
I got to ask at this point, well, first of all, we'll zoom out to zoom back in a quick second. I do want to share with everybody out there that Chuck does, in fact, have his YouTube channel, and it is one heck of a YouTube channel where he is dishing out a lot of dividend stock ideas, great value opportunities, and of course, he's using his Fast Graph tools to do it. So if you haven't been to the Fast Graph channel, check it out immediately after this video. You got to see these stock ideas that he has from the Fast Graphs tool. I can vouch from a week-to-week basis. I'm watching Chuck's videos. So we'll zoom back in here. And I want to talk about actually when you got started investing and on a personal front, because again, this story intrigues me here. So you left university, you were inspired, but you also shared so many tidbits of knowledge here, right? When it comes to fear, when it comes to the market cycles. And I want to know, right? Even you just said no one has a perfect batting average in this business. What in the world even attracted you to the investment world? Like, why get started in batting if you know no one's going to have that perfect batting average and you can take the safer route and perhaps a different industry? What attracted you to the world of investing, opening up your own firm, handling other people's money? What inspired you there?
Well, it goes back to that economic professor I had. I actually started in the business in a partnership with him. As I left college, we formed a money management firm. And then we had some fallings out. It was really, I really have a great deal of respect for him, and I think he, me, but we had a different idea of how you would run a business. So I ended up forming my own, firm. But the whole idea was helping people. And, I did it starting out managing money. Investing fascinated me. I just was always intrigued by it. I always liked it. I was always interested in it. Some people like, like engineering, and some people like medicine. I liked investing. I just thought it was, a fascinating subject. So I followed that career, and I also found out I could help a lot of people. And going back to that Pershing study that I mentioned in the beginning here, that was the kind of the father or mother, if you will, of the Fast Graph tool. The problem was, they did it on the market, Pershing did, and I wanted to see individual stocks. So my wife is also my partner, and we formed Fast Graph together. In the beginning, it used to take us 4 hours to draw one chart because we used to have to buy data. It was going back in the old, technology. It wasn't anywhere near what we have today. And we would have to get the data, get the prices. We'd have to parse them, which meant you had to split adjust them and do it. And, we'd create these graphs and we do it. And it would take us 3 or 4 hours to see the earnings and price relationship of Home Depot. And that's what Fast Graphs is all about. It's the fundamentals analyzer software tool. It illustrates the correlation between the company's operating results and what the stock price has done. And so it very clearly articulates periods of overvaluation, undervaluation, and fair valuation. And so we used to do that, and we just loved it, and we found out it was helping us even run our money management firm, because instead of just looking at stock prices and being subject to the folly of rising and falling stock prices without no perspective of what the value of the business was, people had the tendency to have their fears, had gasoline poured on the fire, so to speak. But once you could look at a business and say, gee, this company's doing great, now the market's selling it at a ridiculous valuation, you could invest with confidence. And also you could recognize when the market was irrationally, overpricing your stock. So, helping people make better investment decisions is something I'm very passionate about. And to be real honest about it, I always loved teaching, but I also recognize there was no money in it. So, I'm able to have my passion with my channel, my YouTube channel, et cetera. I'm able to feed that passion, and at the same time, build a product that we can market to the public that is reasonably priced, that can help them be better investors, and it's a win-win for everybody. And so I'm very excited about it, and I, really love doing it. And by the way, I'm ended up doing what I love and love what I'm doing, and I think that's a good message for all people. Find
Sure.
things that you're passionate about and make that your job, because then you don't have to go to work. You're just going out to play every day, and that's
Sure.
what I feel like I'm doing.
That's amazing. I mean, look, you do what you love. You never work a day in your life. Now,
That's it.
I gotta. How did you and your wife meet? I feel like it's so peculiar to actually find your partner out there, your wife in your case, where you both have a love for finance and investing. Was she involved at all in investing prior to know?
She worked for a major brokerage firm, and I met her there because I was working. One of her the broker she worked for was someone that actually was doing business with me, and we met like that. And
Wow.
we had mutual interest, and we fell in love and built a life together, built a family together, and built a business together. Actually, a couple of businesses together. So I was lucky to find my dream girl, and we went through life here, doing it all. I mean, we spend almost every day, 24 hours a day with each other, and it's kind of fun that way.
Sure. Now, do you guys ever disagree when it comes to certain
All the
investments?
time, all the time. Yeah.
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 I,
And,
I
and
I actually had a
in
couple.
fact, she probably, I probably love investing more than she does. She's a
Sure.
very competent woman, really runs the businesses, and I run my mouth. So I go out there but I do the research, and I'd like to do the investing in the stocks, but she actually keeps everything together. So I wouldn't be where maybe I'm behind every good man's a good woman, and there's absolutely the proof positive in my own life.
Sure. No, I love that you said that because I had a couple guests on the show where our conversation led down a route of talking about, your spouse and how important it is to have a partner, a spouse on the same financial level as you are, who cares about money management, finances, looking into the future. And I just love to get your take quickly on this before we zoom back into investing. When
All
it
right.
comes to you and your wife, how have you guys, what would you say has been the most effective means to managing your money together and coming together to a table to budget and to plan like accordingly for life? Because money plays such an integral role in every relationship. And to be honest with you, as a young buck on my end over here, what I see on the playing field today is everybody's in it for fast cash, fast money, want to get rich by Tuesday. It's all about the glamification, if you will, of being on Instagram and fast dating, fast money, fast this. What would you say to those youngsters out there now or watching, or anyone out there looking to actually get into the dating world? Is it important to find someone who is on that level playing field in finance?
It's everyone's different, and I don't know how to answer that question, but like I say, I'm much more passionate about the investing side than my wife is, but she's very passionate about helping people. And I think, and she's also passionate about growth. One of her favorite phrases that I've always really embraced is that, like everything in nature, whether it's flowers, trees, animals, people, anything, when you stop growing, you start going into the process of dying. So one of the things that we've always done is try to grow. We've grown our families, we've grown our businesses, we now have grandchildren, and having that kind of growth. But I think the key thing for all relationships, and ultimately for all success in life, investing, business, whatever it is don't focus so much on the money. Focus on what you're doing, on helping people. My goal is to make FastGraph the very best investing tool to help people make better investment decisions than it could possibly be. And it's kind of a field of dreams concept, build it and they will come.
Yep.
And so the idea is, don't focus on the mundane, focus on the things that, touch your heart and make you feel good about living in your life. And I think as long as we do that, then, and we keep, getting great testimonials from clients, for example, and subscribers, and, know that we're making a difference in people's lives, that gives you the strength and the ability and, the energy to keep going and to even go farther and faster you've ever gone before.
Sure, sure. I mean, it's talk about a real partnership. There it is.
Yeah, that's it.
We'll zoom back in here to investing. Now, we talked a lot about a portfolio size, right? How many holdings? What would you share with a perhaps young or inexperienced investor, or even maybe a more experienced investor who's trying to perhaps, trim their portfolio, reorganize their portfolio, build a portfolio, scale it? What would you say is a good starting point? Should someone begin with looking into indexes and ETFs as a foundation? So should someone go immediately into individual stocks?
Yeah, that's probably an unfair question to ask me, because I don't like what I call packaged products. I never have. And the reason for that, just so people understand, is because, they call me Mr. Valuation. I used to do a lot of writing on the website Seeking Alpha, and back started in 2009, I think, and I wrote lots of articles, and I had a pretty good following there. And they start calling me Mr. Valuation because I was always talking about buying value. I believe everybody wants a bargain in everything they shop for, and we ought to do that with stock. So that's basically been my my forte. I'm always looking for value in the investing world. And I actually lost my train of thought. What was the question?
Should someone begin with looking into building?
Oh, yes. Why? Here's my problem with ETFs and mutual funds and everything else. If you don't have the inclination or ability to do that, then I think they certainly serve a purpose. I don't want to denigrate those. I don't think, but my problem with them is that if you own a portfolio, a mutual fund or an ETF, and it has 400 stocks in it, I can promise you a very large portion of those, especially in a market like we're in now, are going to be overvalued. Sure. And, yes, the market, the average will work out, but I personally just like the challenge of finding and building my own individual portfolios. So if you feel like you like it, have the time and the energy, I would say, build your portfolio one stock at a time. If you don't, then I think you can go to ETFs and funds. They certainly serve a purpose and have a place. Even Buffett talks about, people should just buy the S&P index and, hold it for the long run. And that probably can work out, I think, real well for people in the long run. But I just can't imagine myself owning a stock that's overvalued. Sure. But on the same time, I think there's some other important principles, like I talk about all the time. A portfolio is like a bar of soap. The more you handle it, the smaller it gets. And, you don't want to, water the weeds and pull the flowers. There's a lot of cliches out there that talk about different strategies. I think buying and holding a company over the long run is really the most practical and best method if you have the psychology to weather those occasional down markets that are going to come. And if you don't, then you're trouble in investing anyway. But I just like to, run individual stocks and, build the portfolios of individual stocks that were carefully selected. And, we try to maintain, a good balance of growth and income and so on in those portfolios. But it really depends on the person and their own goals, objectives, risk tolerances, and willingness to do the work, because it does take a little more work to build your own portfolio. It's not to set it and forget it, the old Ronco commercials. But on the other hand, it's kind of nice to, know what you own, get the satisfaction of, designing it and building it. So it really depends on what the person's looking for. I don't think it's good advice to tell anybody what they ought to do from a standpoint of, what's the best. It's what's best for them and what's best for their own, their own psyche and goals and objectives.
Sure. Yeah. And I've often heard that someone's brokerage account, right, is their scoreboard. And if they're up, they're winning nonetheless. They could be winning more, perhaps. They could be losing. But it's really whatever makes someone comfortable as an investor. So I love that piece of an insight.
Yep.
I know as Mr. Evaluation, right, in your years of experience, yet you must have had, at least here or there, a stock or two that didn't perhaps perform as well as you would have liked it to, or was a learning lesson. If you can speak to the biggest mistake you think perhaps you've made on a particular stock, throughout your years of investing?
You know, I think a very important principle. In fact, it was kind of interesting. My son and I played a round of golf together over the weekend, and he's a partner in my fast craft business, and he was talking about how these bad drives he had hit, but I've also seen him hit these fabulous, great drives.
Yeah,
And the point is, I think it's much more practical and much more beneficial to focus on the winners, to dwell on the things that you've done right, and to try to just learn from the things that you've done wrong, and then let them go. But, be
sure.
in the present moment and always be looking to the future. So I've certainly had my share of stocks that have dropped in value. I've had stocks that have gone, that have declared bankruptcy. But if you're paying attention to those, I've never really had 100% loss in a stock. That's not really been the issue. And again, believe it or not, I don't really remember the ones that I've lost money on, but I do remember the lessons.
Sure.
And so to me, it's focusing on the fundamentals first and not the stock price. I don't react to stock prices. I react to changes in fundamentals.
Sure. I love that. So we'll go on the flip side of that coin. Can you speak to at least a success, like a massive success you've had, maybe a stock that's shot up, soared 50, 60%, and you've made a heck of a lot of money throughout your history in investing?
Well, I mean, one thing we didn't probably talk about, when I was your age, probably, I was a growth investor predominantly, but I still had dividend stocks in the portfolio. But,
Sure.
I was investing in names like, made a lot of money in Microsoft, a lot of money in Apple, a lot of money in, more recently, Visa and MasterCard. There were certain stocks I never owned because I never got a chance to buy them at value. For example, Starbucks, which I've mentioned earlier in the conversation. I just never got a time to buy it at an attractive price. But, growth at a reasonable price is a great way to invest, but you got to be willing to have the discipline to pay a reasonable price and to be patient to wait for that reasonable price to come to it eventually, inevitably will. But I've had a lot of great stocks and runs, and there are stocks that I've sold that where I felt got overpriced, after I'd bought them and owned them for years and years, that made me cry when I had to sell them. But
Sure.
I don't trade very much. I will say that it has to be an extreme overvaluation, an extreme risk for me to leave a stock. But I've had my share of winners, I've had my share of losers, but that's why diversification works.
Sure.
It won't destroy the portfolio, and one won't make a portfolio and one won't destroy a portfolio. But a couple of really big, fast growth stocks like Microsoft or Apple, bought at an attractive valuation at the first place, can end up being great, investments. But on the other hand, you can buy a, stable, moderate grower, AAA rated Johnson and Johnson at a fair price. And it built, I was born and raised in Pennsylvania, and they call it the Keystone State.
Mm-hmm.
And the keystone is, of course, the stone that holds the arch up. It's the center stone in an arch. And I think building a portfolio is always like that. You want to build it almost like a baseball team. You want to have, the couple of home run hitters, but those guys strike out the most. But you
Sure.
also want to have those guys that are 300 batters, that get on base and let the home run hitter clean up for you. So I think it's about balance in life, balance in investing, balance in your portfolio, balance in everything. And again, you can, weigh growth a little more when you're younger, when you have time to recover, and you can then focus more on income as you get a little older. But, it's never all or none. It's always a matter of balance.
Sure. No, I love that you shared that. And I believe it or not, right, I'm a younger guy on YouTube, 28 again out there, but my demographics, and it's probably because, right, the material on my channel is dividend investing. So the demographics for my channel are honestly over 35, right, 40s, 50s, 60s, more near retirement. When would you say is an ideal time for someone to change their strategy if they're a younger investor getting older? And what would you say to those investors out there who perhaps got into the investment game a little too late? They're entering maybe in their early 50s. They don't have too much time before retirement. How should they go about investing?
Well, it's really the question is really depends on what the situation of the person. For example, this is a true story, by the way. I had an investor come to me once, and they said they had $100,000 and they needed $30,000 a year income. Could I help them? And I said, well, I can tell you this, in 3 or 4 years, you're broke.
Yeah.
I don't care how good your money manager is. You have to be realistic. And so a lot of the decisions that you want to make with your portfolio are going to be relevant to how much you've accumulated over your life, how disciplined you've been. For example, if you've got, $1 million portfolio and you're now entering retirement, and, I think a realistic return or dividend return would be something like, a conservative one would be like 3 or 4%. You could push that out to 6, 7, or 8 if you're willing to take, a great deal more risk. But you got to live in the world of reality. I think of what can these investments do to you? Now, a guy that has $30 million that his fortune had either inherited it or built a business and got it, he can be a lot more conservative, with his money than a person that still has to grow money. So it really depends on the situation of the person. And again, the risk tolerance and so on. So there is no pat answer to those kind of questions, unfortunately. Right? That's the problem. You got to deal with the situation and then be realistic. And by the way, if you have $1 million portfolio and you're conservative and, $30,000-$40,000 a year income, if you have to live off of that, supplemented by things like Social Security and things, is the reality that you're living with. But what you don't want to do is take that $1 million portfolio and try to turn it into $10 million by taking excessive risk, because then you could find yourself 2 or 3 years from now broke, or
Sure.
half the amount of money you started with, and now you can't survive. So, it really depends on the situation a person is in. I do say the best possible advice anybody can get, your age, young, starting out, is be a saver. Whether it's buying mutual funds and ETFs or buying individual stocks or putting it in the bank, in a savings account. When you look at the law, the power of compounding, that's, really, even at 3 or 4 or 5% a year, you can end up accumulating a pretty nice nest egg. But it's a matter of being disciplined,
Sure.
putting a little bit of money away every month, every paycheck, whatever it is, will help you get to financial independence in the long run. And the sooner you start, the better your chances are. I will also tell you that. But again, monitor how much risk you're willing to take with the capital that you have. But there is no right answer or wrong answer to those questions. It depends on the individual.
Sure. Now, to that end, we also have a lot of questions that always come in about, right, taxes as dividend investors, and especially so if you're playing right into tax advantage accounts, into an IRA, right, you can play the game of taxes, if you will, especially with dividends and all the growth and the gains. What's your opinion or stance on taxes with dividend investing? How do you look at it? Would you share with someone to use tax advantage accounts first, or?
Sure. I mean, but again, they're limited. You can only put so much in those accounts.
Sure.
You can only shelter so much. And death and taxes, the only two things in the world you can't avoid. And, there's a reality to that. But my philosophy is never let the tax tail wag the investment dog. I think that's very, very important. My goal is to always attempt to earn as much as I possibly can, whether it's through capital appreciation or dividends or interest income, whatever it may be. Try to earn as much as I can, commensurate with the amount of risk I'm willing to take to do that. Sure. Because ultimately, the more you earn, the better off you're going to be when you come to the other end of the equation. But you can't avoid taxes. You can mitigate them. Like, for example, if you buy a great growth stock, you get the advantage of an accretion. You can buy it at $1 and hold it till it's worth $200. And you've had tax advantages all the way through that because you paid zero tax because you haven't sold it until they changed the law, by the way, which they're talking about. And when you got dividend income, you're going to have to pay a little bit of taxes on the dividend income. But if you got it in a retirement program, you can shelter that as much as you possibly can. So take advantage of all the tax advantage opportunities you have. But then at the same time, you always want to try to, do as well as you can with your investments. And that's really the only real ultimate weapon you have. Make as much money as you can, commensurate with the amount of risk you're willing to take to do that.
Sure. I love it. I've seen my whole career in investing, and even since, my youth, I've had a lot of great inspirational figures in my life that have always given me the tidbits of knowledge to keep me going and keep me on a steady path, right, towards what I like to say success, right? And where I'm at today is I can look back in my past. I have an uncle of mine who worked at Fidelity for about 20, 25 years and managed, well, a lot of money there, billions of dollars worth of money. And pieces of advice that he always shared with me is, of course, always have time in the market, right? Never try to time it. I have my father on another end of the spectrum that says, oh, he's still to this day to me, what gets measured in life gets done. And so when I look at my life, right, I had a lot of
that's good
inspirational,
counsel.
yeah, a lot of inspirational financial figures. And I know that you had the professor. I'd love to know who your investment hero is or your investment inspiration. Who was it over the years? We'll put on the larger spectrum, like a guy like Buffett or Peter Lynch, you even mentioned.
Well, I've made it a business of studying the masters, people like Buffett and Lynch, and I mentioned Marty Whitman and Phil Fisher and Ben Graham and
Yep.
all those guys because I tried to learn from the best as much as I possibly can. So I have studied them and studied, their behaviors, and that's why value investing works so well. I've never been much of a proponent of quote unquote modern portfolio theory, which was a lot of academic mumbo jumbo. I think Charlie Munger, Buffett's partner, once said, it's a lot of fancy Greek letters and long, mathematical equations that doesn't amount to anything but dementia and twaddle at the end. And, I don't want to be too overly demeaning to academia because I think academics play a real important role, and some of the studies they do have been really meaningful. But I don't know that I have any heroes. I just have smart people that I've studied and studied their behavior and then tried to emulate that behavior as best I can and tried to take the most important lessons that they teach to heart as much as I can. So again, knowledge is power, and that's what I've tried to do with my career, and it's served me well.
I love it. I'm sure you've read and studied a lot of books that have been out there, unless you've met some of these very smart people within the.
I've not had the occasion to meet them, but I have read most of their work. Yeah,
I'd love to know maybe your top 2 or 3 book recommendations for us investors out here. If we're looking to invest like Chuck and get ahead of the game, what book should we add to our list?
Well, of course, the one that's not very impossible to find is the Ben Graham title eludes me now. The Intelligent Investor, is that it?
Yep. The red cover, right?
Yeah, that's
yep.
I have the book, and it's you pay a fortune for it. And of course, I've read almost everything on Buffett. Peter Lynch's books, especially One Up on Wall Street. I didn't like the second one as much. It was just a rehash of the first one. But One Up on Wall Street was a great book. Phil Fisher, Common Stocks, Uncommon Profits, I think is a classic. I mean, there's so many of the real classics out there, so many books on Buffett and so many writings about that. But anything that's about true, what I call fundamental investing. Fundamentals matter, and they matter a lot. And I say that all the time in my YouTube channel. And, that's the real key. You want to focus on the business. The secret of value investing, by the way, people just don't really realize it, is you want to participate fully. Because it's one thing to identify a great business like Apple or Microsoft, that you can pay way, way too much to buy them. And the company does great and you do crappy as an investor because you overpaid for the stock. The key is to identify great businesses and then participate fully in what those businesses are capable of generating. Because that's why you invested in them in the first place, because you thought they were a great opportunity. Well, make sure you participate in the opportunity. But anything about good, sound, fundamental investing, I think, is worth it. And One Up on Wall Street is one of my favorites. Common Stocks, Uncommon Profits is another one. The Intelligent Investor, of course, is a classic. And by the way, you got to read some of those books and recognize that some of the things in them are dated. But I've got a library. I'm not in my library right now, but I've got there's so many other books that I've just memory has caused me to fail to mention. But anything about good, solid investing strategy. I don't believe in speculating. I don't believe in timing the market. I do think it's time in the market. I do agree with your uncle. And I do agree that buying and holding a great business, that's what you want to act like an owner.
Yes.
You want to invest as an owner of a business, not as a day trader or a speculator. If you want to do that, go to Vegas, enjoy the shows, take a little money and have some fun. But if you want to be an investor, you want to be, more serious with your money and your approach.
Sure. No, that's, I heard that from Warren Buffett when he spoke about, I think he was lecturing in front of a class, but he spoke about becoming a farmer, if you will. And you wouldn't
Yes.
buy a piece of farmland and sell it by next week. You'd buy it for decades. You'd farm the land. It'd probably be generational, and you have your farm. You're not just buying and selling
Well, I
and
think
numbers.
he actually talked about that, where he talked about when he purchased, um, might have been the Washington Post, and then he purchased a farm in upstate New York. He said the only difference in the two investments was there was no damn fool leaning over my fence, giving me quotes about what he'd pay for or what he'd sell me my farm for. That was the difference. And, the farm just plodded along, so to speak, no pun intended, and just
Sure.
grew in value, and the land grew in value, and ultimately, it did well. And that's the problem. There's too much noise in investing when you're looking at stock prices. People are buying and selling all the time, and the prices are fluctuating all the time, and that can make you crazy. If you look at a stock price chart, it's crazy. It's volatile.
Sure.
You look at an earnings chart, and it's much more benign. And then ultimately look at a dividend chart, and it's really benign.
Yeah, sure, sure. I'll ask you, we got a couple more questions here. One of the concluding questions I want to ask you are about glaring red flags in the market and in stocks. Now, as we head into what may be an uncertain year, right? I know you're not too big into the macros. You're going to keep to your strategy, especially with fast graphs. It works, right? It's been working very well for you. But what are some glaring red flags that we should look out for as investors when it comes to a stock? Pitfalls we should avoid. We talked a lot about successes, but let's talk about these red flags that we should all have on our radar at least.
Well, a lot of the red flags are, subtle. You don't see them, you don't see them until they hit you, broad face. But I do think valuation is one of the real key principles. And the idea there is to not make what I call the obvious mistakes.
Sure.
Don't overpay dramatically for a stock just because it's a great story. Artificial intelligence has all of a sudden, created some, crazy valuations on certain stocks, good companies that have now just become ridiculous. So valuation, and focus on things like earnings yield. Earnings yield is simply the inverse of a PE ratio. And, Ben Graham said, don't ever pay more than 15 times earnings for a company. Now, he was talking about, I think, the average or normal stock. And he was also making that statement during a time, back in the 20s and 30s when, it was kind of the industrial age.
Sure.
But, a 15 PE implies a 6.5 to 7% earnings yield. And why would you invest in a stock that if the company paid you 100% of all their profit, they pay you 1% or a half of 1%? You want to say that, you want the stock to make, the earnings of the company to represent a rate of return that's meaningful. And, 6.5 to 7 or 8% is like the average return on stocks. There'll be periods where it's better, periods where it's worse, but over 200 years or so, that's your average rate of return. So, I don't ignore macros. That's, I think wrong thinking, but you want to always think of those things in context of what valuation you're getting. And valuation is really a function of earnings yield, I think. More importantly, multiples, it's how much money is this business capable of throwing off to you, and is that acceptable? Will that meet your required rate of return, so to speak? So, the big red flag is valuation. If the market's, crazily valuing a stock, then, be patient, because stocks they do revert to the mean. Undervalued stocks will become fully valued again and overvalued eventually. Overvalued stocks will become fairly valued and undervalued eventually.
Sure.
But again, buy for the long run. Don't be trying to chase the bouncing balls of stock prices every day.
Sure. Now I can 100% understand why they have dubbed you the Mr. Evaluation. I've heard evaluation throughout this entire interview, and you've been on the money every single question. I got one final question for you, Chuck.
All right.
I'm really going to put you up there on the hot seat here. I want to give you 10,000 virtual dollars here. And speaking of into Mr. Evaluation, what company right now, if you had to pick an individual stock to place this $10,000 in right now, what company would that be?
That's probably the most often asked question I have, and I'll give you the same answer. Okay, there is no such thing. I would give you at any moment in time 20 to 25 stocks to put your money in, but I would never recommend when all the money going into one stock. I just don't think there's
Sure.
any stock that's that good. So the idea would be to identify 20 to 25 stocks. By the way, I wouldn't even object to owning, Charlie Munger, who's pretty abrasive if you know anything about it. That's Warren Buffett's partner, for those who don't know. He talks about owning one or two stocks. Well, you got to really know those companies if you're going to own one or two. So my answer is look for the best value you can find and the highest quality company you can find that meets the goals and objectives you're looking for. And then try to do that 20 to 25 times. Try to diversify your portfolio. Don't ever put all your eggs in one basket, because there is no such thing as a perfect company, and you cannot have perfect knowledge. The only thing certain about the future is that it's uncertain. And
Sure.
so there's no stock that I would ever have that kind of conviction on. But, a stock of 25, recognizing that I might have 3 or 4, bloopers in there, or 4 or 5 even, doesn't destroy my financial life. That's the key. So,
Sure.
you have to diversify. So I would never answer that question. Sorry, Ari, I wouldn't answer that question.
No, you know what? I wouldn't
And by
expect.
the way, the answer would be different every time I was asked, depending on what day, what month, and what year it was.
So we'll get you on in a week. We'll ask that question. Just one more question.
Right.
I wouldn't have expected you to answer that question any differently, though, because it's right in line with your strategy. It's right in line with how you invest. And it's a strategy that's been working for you. And out of every guest that I've asked that question to, I have to be honest here in sharing with you that you could tell a lot about a man by how he answers his questions, how calculated he is, how much wisdom he brings to the table. And that's about as much wisdom as I've ever heard in an answer for that question. So,
Well, thank you.
of
Appreciate
course,
it.
well, investors, thank you. Let us all join together. Thank Chuck for being with us, joining us today. Fast Graphs, it's a tool that works. Again, you got to jump over to Chuck's channel. I'm picking up stock ideas every single week from Chuck and using the Fast Graphs tool. So highly recommend jumping over there. And Chuck, I want to personally thank you for joining me, because I've been watching you as an investor and following suit on a lot of your videos. And I've learned a lot of insights, not just from today's interview, but moreover from each video that you're sharing with us. You're certainly right along with your mission and helping all of us investors. So I want to thank you on behalf of all of us investors for that. And I hope, and hopefully in the near future, we can have you on again, ask you that one last question.
It's been my pleasure. I've enjoyed it, and I want to thank you. And I wish you a lot of luck with what you're doing. I think it's important to get this kind of message out there to people, and there's so many charlatans in the financial world, but there's also some really great people in the financial world as well. And I like to support the great people.
Thank you so
Thanks
much.
for having me. I look forward to seeing you again.
Thank you so much. And investors, until next time, we will see you all there.